Fine Business Radio with Lindsay Williams is proudly brought to you by Prudential. All things considered.
It's just after 6 o'clock on Tuesday, the 20th of May 2014. I'm Lindsay Williams and this is Fine Business Radio on FMR 101.3 FM. Also good value is the brilliant Lee Adler, who is the founder and editor of the Wall Street Examiner. He's called the US market right for 4 or 5 years. And let's see what he's got to say about it today. Let's now talk about the US markets and specifically the S&P 500. We can expand it if we want, but on the telephone now from Florida in the United States of America is the man that's called the S&P 500 better than anyone probably in the world, actually. I'm not exaggerating. It's Lee Adler, the founder of the Wall Street Examiner and also the editor of that institution. Lee, the market has sort of stalled a bit, hasn't it? We did go to 1902, I think it was last week, 1902, 1903. It doesn't want to push on, but it doesn't want to come back. There's like an impasse at the moment.
Yeah, it reminds me of the old Elvis Presley song, Suspicious Minds.
Yeah.
You know, we're caught in a trap and we can't walk out. And I was going over a long-term chart with my subscribers the other day on a video that I did, and it's clear that there's support at around 1850 and resistance around 1900, and this support and resistance comes from a couple of long-lasting trend lines that are actually heading towards a convergence at the end of July. So we should get a resolution at some point in the next couple of months, and that seems like an awfully long time to stay stuck in this narrow, frustrating trading range. But the forces of supply and demand are pretty well in balance right now, and these support and resistance levels are very strong. So that's what's kind of keeping things in check.
Looking beyond the end of July, when this convergence occurs, should it occur, is your bias to the upside as it has been for so long?
Well, slightly. The thing about this convergence, these are trend lines, so they are converging. They're heading towards one another. And the crossover point is the end of July, early August. So at some point, the market has to break out of the trading range because the range is getting smaller. The problem is that let's say we break out above 1900. Everybody's going to get all excited and then all bulled up, but there's another very long-term trend line just above at about 1920. The S&P is in what's called a broadening pattern. That's a classic technical pattern of higher highs and lower lows over a period of many months.
Like a megaphone, in other words. Sorry to interrupt. Like a megaphone formation almost.
Exactly. So we're in this megaphone, bullhorn, broadening pattern, whatever you want to call it. And again, if we get a breakout above 1900, well, don't get too excited while everybody else gets too excited, because it could be the trap. It could be the move that fools the majority. It could be another bull trap, in that it'll run up to this next resistance level at 1920 and then stall there. And I think that's a likely possibility. We have a similar problem on the downside, although we're not anywhere near the bottom of the megaphone pattern. That's down below 1800 now. But 1850 is a key support level. So if you go through 1850, well, then everybody's going to get all crazy with fear and figure, oh, we're finally going to have this 10% correction or a bear market, or, you know, the serial crash callers have been out there for a year or more calling for a crash. It's not going to happen, I don't think, because there's a more important support level at around 1840. So they need to take out 1840 for there to be a really meaningful correction. I think the likelihood is, unfortunately, that we'll get a false breakout one way or the other. Everybody gets all excited, and then we get another whipsaw. That's been the character of this market, to constantly whipsaw, have minor breakouts and whipsaw, and I don't see any significant reason that would change in the immediate future. So, yeah, I think 1920, 1930 is a reasonable upside target, and 1840 on the downside. Once you get past those levels, and I don't know when that's going to happen, obviously it's going to happen sooner or later, then we can get an extension of the trend, either up or down. My bias would still be to the upside based on the printing by the central banks, by the Fed, the Bank of Japan, and also the PBOC, China's central bank, because they had been tapping the brake through say 2012, and then there was a lot of discussion that they had been tight in 2013. But if you look at their balance sheet, it's been growing pretty steadily with a couple minor exceptions too. So outside of the ECB, which is the only major central bank that isn't printing, the BOE, but they're much smaller. The Fed, the BOJ, the PBOC, they're all printing pretty steadily, and the taper really hasn't cut that much. And I can explain that if you'd like.
Yeah, I would too. But what I would say to you is there was a couple of data points, as they say, that caught my eye just last week, I think it was. Jobless claims at a 7-year low, and also inflation just starting to pick up. I mean, it's coming off such a low base. It's nothing to worry about. But the point is, psychologically speaking, that is what's happening. And perhaps that might accelerate the tapering process. And again, it may be psychological, because it's been proved that from an emerging market currency point of view, that tapering doesn't mean anything. And there's no relationship between less quantitative easing and the performance of emerging market currencies. But I just thought that perhaps Janet Yellen might, as she's such a conservative woman, might say, yeah, maybe we'll accelerate it from 15 to 20 billion every couple of months. What do you think?
Oh, I don't think they're going to make any significant changes, but I don't know what they're going to do. If a crisis develops, they could go the other way. I just don't know. I'd rather watch what they do than try to speculate on what they're going to say or what they're going to do, because the markets really don't discount the future. They just react to the amount of liquidity in the system. So when that actually changes, then unless you're moving billions and billions of dollars, if you're a smaller investor, you'll have plenty of time to react when there actually is a policy change. But the point about the taper that I wanted to make is that the Fed has carefully calibrated the amount of QE, the amount of money printing that it does each month, to the amount of new treasury supply, so that as the U.S. federal budget deficit has come down over the past 12 to 18 months, the budget deficit has dropped from, say, $100 billion a month to around $50 or $60 billion a month. And lo and behold, that's about how much the Fed has tapered QE. So they're basically calibrating QE to the amount of new treasury supply, which means there's just as much excess cash around now as there was before they began the taper, because there's less treasury supply to absorb whatever the Fed is printing. So there's plenty of money if the dealers elect to commit it, and there's a lot of money on the sidelines now. One of the metrics I watch is the Fed's reverse repo outstanding, where they take in cash from the dealers, the banks, and the money market funds, and these institutions lend this cash to the Fed on an overnight basis. Well, that's up to $200 billion, which is a near record amount since they started this program. Now, this is just overnight money. They can deploy this money the next day. So this is cash that's just sitting there waiting for something to happen. So it could be, just a matter of days, weeks, or months before this gets committed again.
Well,
so I still think there's plenty of liquidity out there to drive the market higher. The mistake that could happen would be that the Fed elects to continue tapering, or as you said, possibly accelerate it, although I doubt it, in the face of increasing treasury supply. And if we look at the government, the federal government, U.S. federal government's tax collections over the past 6 or 7 weeks, they've been declining. Withholding taxes that are collected from workers each week have been declining, suggesting that the economy is beginning to slow. That would indicate that we're going to have more treasury supply going forward. Now, if treasury supply increases and the Fed is still continuing to taper QE, at some point you get to a crunch. That process would take months, but that's something to keep an eye on, something that I'm watching very closely.
Well, this business about tax collections is quite interesting because we've just, since we've been speaking, got the Caterpillar results out. Their sales have declined, for 17 months in a row, and this is their biggest monthly or quarterly plunge, rather, since 2010, I think it is. I mean, okay, Caterpillar's got nothing to do with Main Street, but it's got something to do with the world economy, and macroeconomics may be, at last, starting to exert a force, Lee.
Well, we've had an expansion. I wouldn't call it a recovery, but there's been modest economic growth in the United States since the middle of 2009. Like it or not, economies are still cyclical. And by some measures, I may be crazy, but the market, the economy looks overextended. For example, what you mentioned a few minutes ago, the initial unemployment claims being near record lows. That indicates an economy that's actually overheated. So the U.S. economy may have expanded as much as it can under the circumstances, having the weak fundamentals that it has. It may actually be overheated in some sense and may need to contract for a while. And the 6 or 7 weeks of declining tax collections could be the canary in the coal mine that indicates that, yes, the economy is beginning to slow. Now, 6 or 7 weeks is not an awfully long time in the big economic picture, so we'd have to take this with a grain of salt. But if it continues, it is going to be a problem.
Now, how do we get hold of your unique wisdom, Lee? Remind us again of how we get hold of the Wall Street Examiner.
Just go to wallstreetexaminer.com, and if you're interested in my proprietary research, that's in the Wall Street Examiner Professional Edition. And again, you can find information on the website. I have a risk-free trial at wallstreetexaminer.com.
Okay, so we just subscribe to the professional edition and we'll get the sort of stuff that you've been talking now, but embellished in a more expansive way.
Lots of charts, and I try to explain things as clearly as I possibly can so that investors can make up their own minds about what these forces mean.
Lee, thanks so much for your time this evening. That's Lee Adler, who is the founder and editor of the Wall Street Examiner.